pay less attention to what you read in the newspapers, because you could get the story right, but you probably get the market wrong. Take tariffs. If you thought tariffs, they were going to, destroy the economy, and you would get the market wrong. If you were an expert on COVID and you got the COVID scare right, you got the market wrong, right? Ooh. So pay less attention to the news, read with the understanding of what it's trying to accomplish, and pay more attention to this price action in a vacuum, right? I think, we all want to be smart, read up on the news, and, we could talk to clients about, at the end of the day, there's a big separation between markets and news, markets and the economy, markets and GDP. So if you want to be a student of the market, study the market, and everything else is secondary.
Hey there, everyone. Dave Kettler here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, we're speaking with technical analyst JC O'Hara. JC is the Chief Technical Strategist at Roth Capital Partners. I've followed JC and his work for a number of years. Just saw him recently at the CMT Association event in Boston and asked if he would come on the podcast, and he thankfully agreed. We talk about a lot of things in pretty timely conversation here in early June. We've got technology and other growth stocks going onward and ever upward with exceedingly high valuations. We've got a SpaceX IPO coming out here pretty soon. So we talk about trend following, we talk about momentum, we talk about risk management, we talk about volatility, and a lot of other lessons learned through a successful career in technical analysis. So please enjoy this conversation with JC O'Hara of Roth Capital Partners. JC, it was great to see you in Boston a couple weeks ago. Thanks for coming on the show today.
Absolutely. Boston. I haven't been to Boston in a little bit, and I was pleasantly surprised at how nice that downtown was. The Seaport area is beautiful.
So funny story about that. So we did the event we were at, the CMT Association event. It was on that Seaport district. And when I was there, like 2008 to 2016, the big dig was just kind of wrapping up. And that was all like parking lots and empty buildings and kind of this weird part of town you never talked about. And you saw it. It's absolutely ridiculous how nice it is. Just all new buildings, residential areas, a lot of young professionals. That was pretty cool. That's one of the cooler parts of Boston all of a sudden, right?
You know what? And if you were, questioning whether we're in a bull market, just go down to the Seaport. We're in a bull market, that's for sure.
It reminds me of like when I went to San Francisco, there's the huge Salesforce office going up, and I'm like, ooh, yep. Okay, there's a message, there's a market message in there, JC. We'll remember that for sure. So listen, we have a lot going on in the markets here in early June. So I'm not struggling to come up with things that we could talk about. I'm struggling to think about how I want to best use our time as viewers and listeners with a market expert like yourself, JC. And it's been awesome to watch your trajectory as an analyst over the years, and you've had much success, and I think very well deserved. So tell me this. You've spent much of your career working with institutional investors, and for the people listening and watching, and you've been helping those institutions, use technical analysis and think about it as part of a larger process. What's something, would you say, that the charts are teaching us today that most investors aren't seeing clearly?
So that is a great question. I think the first thing that really jumps out to me is valuation is helpful in markets, but valuation isn't the single thing you need to lay your hat on, right? Mm-hmm. Valuations are great trajectory when you're looking out 5-10 years. But they get very blurry when you're looking out 6 months, 12 months, 18, or even 24 months. And I think you're seeing that play out in the market here today, where, before everybody couldn't buy the market because the market was expensive. And then they found reasons to kind of rejigger valuations and, let's look at the equal weight S&P rather than the cap weight. It looks cheaper. Or, great example. Look at SpaceX, right? We're expecting this IPO next Thursday, Friday. It should be priced.
Yeah.
I was reading an article today saying the SpaceX, the price to sales, and I'm going to get the numbers wrong, but the price to sales, they're high, but they're below Palantir's peak, right? So you're justifying fundamentals, you're justifying how expensive things are based off of one or two valuation metrics, And to me, when we're in this year 4 of a bull market, you pay attention to valuations, but you really shouldn't be focused or obsessed with them. And I think that's what the charts are telling me right here.
I feel like there's so many. I mean, when you look back at market history, right? I've heard in my experience, right, when people start complaining about valuations, that usually just means we're in the good part of a great growth led bull market phase.
Mhm.
I feel like every previous sort of major bull market, people complain about valuations on the way up there. So do valuations play a part in your process? And is there just a different part of the market cycle where it makes more sense? Or for you, is it more of a timing thing, right? And we're, because I find a lot of, to your point, I think a lot of people complain about valuations and think about it in the short term as opposed to the long term. So is there a value there? And have you found, clients have been able to combine that sort of thing with a good technical process?
I think valuations make a lot more sense when you're in bear markets, right? Because
Yeah.
when you start to see single digit PE levels after a 20, 30, 40% decline, all of a sudden that becomes much more attractive for the longer term value sort of players to step in, stabilize the market. And that gives you comfort, right? It can't get much worse, aka cheaper, than it is right here.
Mm.
So valuation to me, that's the beginning of a bull market, right? That bear into bull sort of reversal. To me, that's where valuations just offer some stabilization. And once the bull market, starts kicking and, the bull becomes alive, valuations, kind of move to the backseat.
Mm. Some really good points in there. And you mentioned SpaceX's IPO. We're gonna put a pin on that one because I'd love to come back to that because that is some potential market moving, I think, realities here in the coming weeks. But to your point, I think, the famous quote, buy when there's blood in the streets. I feel like valuations are one of those ways you can kind of quantify how bad is it, like how bad our price is reflecting, future growth. So you bring up this really interesting point, which is I think a lot of people think of things like valuations as an all the time indicator, right? It's, in a bear market, you look for low valuations. In a bull market, you avoid high valuations. But that's one where I think the buying approach kind of makes sense, right? Buying low valued companies, that's intuitive. Selling overvalued companies often does not work well because those uptrends kind of last. So I guess my question to you next is, in your experience, like what does your sell discipline generally look like? And I'm asking that at a time when obviously a lot of big technology and growth companies have been in these consistent uptrends to the point that I know a lot of investors, hopefully they bought them a long time ago, starting to feel less and less happy about, when is the music going to stop? So how do you sort of approach this sort of point where it feels like we're going onward ever and ever upward, but at some point we're not going to anymore?
Well, I'll stick with the valuation, point here for a second. And I think it's, important when we talk valuations, there's not just one simple valuation metrics that applies to all indices, all sectors, all stocks, right? If you look at insurance companies, they don't trade on, price to sales. They trade on price to book. If you look at a growing tech company, they have different valuation metrics that matter to them. So I think an exercise that is very helpful, and I've done it years ago, and I do remind myself of it in these certain environments, is look at individual stocks, see what valuation metrics that they key off of, and then run a 2-3 year Z score to find out when they're really expensive and when they're really cheap. So forget about the absolute level of the valuation metrics, but find out how does IBM look versus IBM on this particular valuation metrics. Does that scream expensive or not? And when you start seeing, the Z scores, reach the upper portion of the band, then you could exercise some sort of sell discipline or trimming or some, risk management techniques, right? So I think it's important to do it almost stock by stock in your portfolio.
JC, that feels surprisingly to me like you're applying a technical approach of thinking about momentum swings to a fundamental factor like valuation. So I'll let that sit as you said it. So valuation makes a ton of sense, and I appreciate what you're saying. You're absolutely right. I mean, with different sectors, even different groups within the sector, there might be different ways you want to value things. Mm-hmm. So from a technical perspective, what does your exit strategy look like, and when and pick any of the high flying names we've been experiencing recently? There are many to pick from, but like semiconductors come to mind, these long-term uptrends. where do you, what does your technical approach look like to help you make sure you lock in as much gains as you can and avoid holding it on the way down, which is what we're all afraid to do, I feel like.
So there's a few different camps and how you think about exiting, right? Simple trailing stops work sometimes. 3 times daily ATR, that works sometimes. But for me, we're in a momentum market, right? The average stock has done nothing, but what's working is momentum stocks. And I found it best to, when you have a momentum stock, you have to give it a leash to run, right? If you have a trailing stop that's too close, we're going to get, you probably would have been stopped out already, right?
Yeah.
If you look at NVIDIA or whatever high flyer we want to point to, you would have been stopped out already. So, an exercise I used to do, which actually doesn't work anymore because maybe something's broken, but look at the VIX. You take the VIX and you multiply by 2 or 3, and then that's, sort of the trailing stop you want to put on. So if the VIX is high and momentum's moving, give yourself a lot of wiggle room, right? If you have a stock that's up 1,000%, why is it that you have a 7% stop loss, right? Give yourself 20% on the downside so you don't get stopped out, so you catch the next 1,000% on the upside.
No, really good points. And I feel like that's one of the traps certainly newer investors get into is static or, a simple percentage stop is easy to implement and obviously easy to remember, but probably not ideal for most things, right? Just because the volatility can either, the stop's never triggered or it's triggered way too early. So you've hinted at your experience as an analyst and as a technical analyst, and JC, congrats again on the successes I've seen you achieve over the years. I'm curious, as you've grown in, tenure and have more cycles in the rearview mirror behind you, how has your technical approach evolved? Are there things that you used to find valuable that have kind of fallen out of your, sort of area of focus? Are there things that you've learned over time are more and more important? Tell me about your toolkit and how it's evolved over time, if you could.
So I started as a very traditional technical analyst, right? Read all the books, studied and really sharpened my tools with, the basic technical indicators, RSI, MACD. And, that helped me, really start in the business. But then as you're talking to clients, as the markets evolve, your toolkit it has to evolve with it. So rather than spend time on what I'm not using anymore, let's focus on what I have been paying more attention to and what has been giving me better signals for this market. And that has been, what are quants doing and what are quote unquote CTAs doing, right? When I talk to fundamental buy side institutions, that is like the boogeyman in the room, like, oh, we're afraid of these quants, or, what are the quants going to start selling here? How much do they have to sell, right? They have no idea what quants are doing. So what we try to do is build models that replicate what large quantitative trend following systems are doing. So we get signals when quants are starting to accumulate and starting to, distribute in the market. And I think that telling clients what quants are doing is very, very helpful, right? So CTAs, right? I think CTAs, commodity trading advisors, they have been rock stars, secret rock stars in the market because they trade in these liquid asset classes, whether it's E-mini futures, treasury bonds, oil, gold, and they've been spot on with some of these trend changes. And just being on the right side of that trend has been very powerful for portfolios.
Really good point. My favorite quote so far that you just uttered: as the market evolves, your toolkit has to evolve with it. That's really well said. I think that's a lesson. I feel like a lot of gravestones for failed investors has stuck with what used to work is on there. And it's so funny. To your point on quants, I feel like for a lot of institutional investors, quants are like the boogeyman, right? You're always you're nervous the quants are going to do something. For individual investors, a lot of times it's the market makers, right, who are just waking up every day trying to mess with retail traders and get in their way and ruin their fills and all of that. So I think those are all really really good points in there. So let's pivot if we could, JC, and talk about the conditions here. we've had this situation where the market obviously is in a primary uptrend. We've seen new all-time highs the last couple months. Just in the last couple days, I mean, now at the end of May, beginning of June, a lot of the technology, a lot of growthy names, which are still in primary uptrends, continue to do so. But technology is the only S&P sector, if I'm reading it right, that's outperformed in the second quarter so far. Everything else has underperformed. So how do you approach this kind of market? How do you help institutional investors navigate a market that feels to a lot of investors so narrow in terms of the leadership structure?
I think you have to be comfortable being uncomfortably narrow in your position and concentrated in your position, right? When you look for new buy ideas, right, and you don't have many, but the buy ideas that you do have and you do hold are really working, that's a little uncomfortable, right? Because you're always trying to find the next best thing. And sometimes, just exercising patience for the hand that you're dealt is of utmost importance. And I think that's the market that we're having here, right? Year 4 of bull markets, you do start to see narrowing come into play. And you are seeing that. That doesn't mean the bull market is going to, end. But just be cognizant that there are fewer and fewer stocks that are working. And I think, talking to institutional clients, something that's been popping up very recently over the last few days and weeks are, rising tide has lifted all tech stocks, right? All semiconductors, all AI plays. And now they're actually looking to separate the winners from the losers. So I think this, this market that's narrow is even going to get more narrow which is going to force other stocks to really ramp up and some stocks to fall over. So again, using that sell discipline that you have, whatever methodology that you prefer, but also letting the winners ride in this market. Right. And, who am I to say, let's buy Campbell's soup, right? That the 500th name in the S&P 500 in a market like this, that probably doesn't make sense. So just be comfortable being uncomfortably exposed to a small group of stocks in this market.
It's so funny. And what I've learned, JC, and you probably, I'm guessing have found the same, is when you follow trends and when you use a technical toolkit consistently, sometimes your process kind of naturally narrows you into certain areas. And earlier in my career, I got very scared about that, thinking, I'm not very diversified, I'm very concentrated. But I realized if I'm consistently concentrated in really good charts, that's actually pretty good. And if it,
yes, it is.
You naturally get into a smaller group, I mean, that's something, I guess, that means the process is working in some ways, and not that you're doing it wrong. So
you know what?
Go ahead, please.
I'll say, Dave, if a report that I recently put out, it was titled "Living in a Bear Market While Investing in a Bull Market," right? That's kind of what we're doing right now, right? The average stock has gone nowhere. Value line geometric average, right? We were talking about this up in Boston.
Yeah.
It's gone sideways, right? I'm not saying it's a bear market per se, but on a relative basis, first year opportunity cost, you're in a bearish position if you held your average stock. So the average stock has done nothing, but the S&P or the NASDAQ 100, that's really where your outperformance has been. So just embrace it, right? Don't try to fight it. Don't try to buy, a 52-week low in this sort of momentum bull market.
So, just today, as we're recording this on June 4th, we have a really interesting day because we've just come out of earnings for Broadcom, CrowdStrike, Palo Alto Networks. And we don't have to get into individual names, of course, but the market generally, and certainly the technology sector, finally taking a bit of a breather after a resilient uptrend. And I think the concern a lot of investors have is because of this narrow leadership, what happens when the music stops for the AI trade for semiconductors? Then, nothing else is going to step up and the market goes down. Just today, we're seeing the Dow and the S&P up because sectors like healthcare and financials all of a sudden are kind of popping. So when you look forward, I mean, at some point, it would seem like there's a corrective move to happen in some of the growth stocks. What gives you confidence or skepticism that there will be other sectors, other, not technology sectors that are able to step up?
Right. I mean, it's silly to come on here and just expect, to bootstrap this and extrapolate this, trend up to the right forever. Right. In 1999, the NASDAQ was up 100%. It had a handful of 10% declines during that 100% rally. So you're open to a 10%, correction, pullback, pause, however you want to label it. And again, that's why, trailing stops, it's, kind of give it some wiggle room there. But the hallmark of this bull market over the last 3 years was, yet tech has been a consistent leadership group. But every time that tech took a pause or needed to catch its breath after like a momentum run, what happened? The rotation didn't see money coming out of the market and rotating into bonds or money markets. The rotation went into other areas of the equity market, right? So until that correlation or until that pattern has changed, I still think you have to give the bull market the benefit of the doubt that rotation will continue to support the stocks that are not tech, right? Look at today. NASDAQ is struggling a little bit, but the Dow Jones is up. Now, who really cares about the Dow? 30 stocks, but the largest weight in the Dow is a bank, Goldman Sachs. And what is Goldman Sachs tied to? Goldman Sachs is tied to the IPO market. So even if tech pauses, there are other areas of the market that still touch tech that could start seeing some outperformance.
Really, really good point. And I really appreciate you describing that rotation. And we're seeing that again, I feel like this week, where when a leading group struggles, it seems like we're seeing rotation within equities just to other areas. And there's plenty of areas of the equity market that have been lagging a bit that arguably are due for a catch-up trade of some point. So then to continue this sort of line of thought, what would be the things you would be looking for? Is there a chart that you would be watching or an indicator that you watch that would tell you, okay, it's no longer just a rotation, now it's something different? Is it a shift in the bond market, something we picked up in interest rates? Is it a rotation to other safe havens? Is it credit spreads? I mean, there are a lot of things we could watch. What do you think is the most important sort of risk measure to watch right about now?
You named a bunch, so I could just say all of the above.
If you like. Yeah.
Well, I'll give you two here. Yeah. The first, credit spreads. I think the credit spreads market, high yield credit spreads, or whatever credit spread you want to focus on, that has been bulletproof, right? The credit markets have kept you in the equity trade over the last 3 years, right? So until I see real stress entering the credit market, again, you still have to give equities the benefit of the doubt. The second indicator, and that's one you didn't mention, so I'll give your listeners a tool that I really embrace, and I follow it. If I say second to second, I'm not exaggerating. I have it up on my screen here. It's called the tick indicator.
Right.
And the tick indicator, I love this indicator. This is one that I started watching a few years ago. This is not one from day one of technical analysis. And the tick index is simply how many stocks on the NYSE at any point, any second of the day, are trading on an uptick versus a downtick, right? And that seems very simple, right? But why is that important? Because that tells you intraday and even at the end of the day, is money coming into the market or is money coming out of the market, right? And at the end of June or at the end of March, like that March low, there was a headline that crossed the tape, something with Iran, and it was a bullish headline. We saw the highest intraday tick reading in the history of our data, going back 30 years, right? So that showed me the market was offsides and the market wanted to buy stocks there, right? That massive signal said, hey, we had a 10% decline, but now major institutions with deep pockets of cash, they want to get back into the market. So until I see something contrary, where you're seeing this giant sell signal coming from the tick indicator, I still think money, while it's rotating, it's not necessarily coming out of the market. So money leaving the market, that would be a pretty good indication to me. And the tick has been a pretty good indicator to highlight that.
Man, the tick indicator. I'm so glad you brought that one up. That's that's a kind of a classic short-term gauge, but when you think about the big moves and what they might mean, I'm glad you highlighted that, JC. That's a really
and even Dave, I'll give your viewers one more. If you take the last tick of the day, and I think that's the most important tick, right? Because that's where all the liquidity is. That's where mutual funds are. That's where ETFs are rebalancing. And you do a smoothing mechanism of 20 or 50 days, you will see when the market is overbought, oversold, when the market is finding its low, finding a roof. And that has been a tremendous short to intermediate term indicator that marks tops and bottoms in the market. So a 20-day moving average on the last tick of the day, very powerful.
Thanks for that one, JC. That's awesome. That's on the rainy day list to dig into a little bit. All right, you mentioned before SpaceX's IPO. I mean, it most likely is going to be the biggest IPO in history, and I've learned in bull markets, I'm often criticized for being a little too bearish and having my contrarian hat on. But for me, when the major index providers talk about completely changing their rules to get the SpaceX IPO in the NASDAQ 100 as quickly as possible, that feels frothy to me. Having said that, I mean, talk to me about with something like this, give our viewers, our listeners an idea of how would you approach something like this? How do you think about the technical ramifications of a new listing? How long does it take until you feel like you have a good sense of what a trend even looks like? Like, what does a new IPO look like with something and obviously something like this magnitude it's hard to ignore it.
Yeah, there's a lot to unwrap with this. And again, this reminds me of Apple. When Apple came out and, everybody wanted to own Apple, and mutual funds were changing their charter saying that I want to own more than 5% of my portfolio in Apple. And I had to change my charter to do that, right? That's exactly what's taking place right now. And that's when Apple started peaking. So I definitely hear you with that. For me, I need to see trends. I think 4 quarters of earnings gives you a proper trend to have conviction with. Technicals, we could trade on one day, right? There's price action, we could trade off that. But for real trend following strategies, 4 earnings, that kind of gives you an earnings trend too. So that's where I feel comfortable. But I look at it this way, right? I look at it as this is continuing to give the market the enthusiasm it needs and rightfully deserves if you're in a bull market to continue to march higher, right? Bull markets are not boring. Bull markets are fun. Bear markets are boring, right? So you don't see this sort of enthusiastic launch, in 2008, 2009, right? You see these closer to tops, right? Not saying this is a top, but this is when enthusiasm is really picking up momentum. When I talk to clients, they know the fundamentals. They know how to value this. They think they know how to value it, right? That's what they're going to, trade off of, because you have really nothing else to trade off of. But, the best things we could do as market strategists and analysts is to become a market historian, right? And look at prior large IPOs and how they were embraced by the market or not, and how they traded. And everybody thinks when you have this large IPO, it's, you could have a good product, but it doesn't always translate to a good stock, right? So we just have to be very careful about that. This could be a really cool company, but is it going to be a really cool stock to own in my portfolio? And the easiest analog is look at Facebook, right? Facebook came out and it struggled. It was cut in half. It struggled for 12 to 18 months. Mark Zuckerberg wrote a letter to shareholders saying, please stick with me. I know what I'm doing. And now Facebook, now Meta, it's, if you own that stock, you're one happy camper, right? So we just have to be willing to maybe give these IPOs some time, maybe not be too enthusiastic that it's a 50% weighting in our book, right? I appreciate what it's doing for the overall market, especially now that you have other areas that the retail investor was really focused on, crypto. Now space is the new crypto, maybe, right? They're giving, the normal, Main Street Joe something to read in the paper, something to follow. And I think that's healthy for Wall Street. And then that's, I think it's good.
That's great as an indicator of enthusiasm. That's a really good way to think about this, JC. And point well taken. We'll look for a note from Elon Musk about 12 months out, reassuring investors. That's the playbook. I appreciate. I'm joking, but I appreciate you talking through that. One final question, where we kind of went right past the whole sell in May and go away period, like it didn't even matter and no one cared. May through October, seasonally the 12 weakest months. Usually around May, I start getting a lot of questions about, is that normal seasonal cycle relevant? So far, it's not been a particularly, helpful way of navigating 2026. How do you think about seasonality in this time of year? Does it play a part in your analysis, or is it more trend over seasonality? How do you relate those two, and what's your take on that here in 2026?
It's definitely trend over seasonality. You pay
Yeah.
attention to seasonality, but that's not the end all be all. And if anything, that plays a very, very minor role in my work. Seasonality is good at, if things start lining up, pinpointing the October low or, whatever you look at. But when I talk about seasonality, you go to a portfolio manager in November, you have a great stock, a great chart, and you say, hey, I think you should buy it. Has a portfolio manager ever said to you, you can't buy this because January was down to the January barometer because I can't buy a stock in November, right? So it's good to know which way the wind is blowing. But from an investment perspective, I'm not going to buy or sell a stock just because, we're in July or we're in August, right? Good companies are good companies no matter what, the wind is doing outside.
Very well said, JC. Listen, you are well spoken and well studied. So I'm curious, my final question, if you could go back to a younger JC O'Hara that does not have the experience and the cycles that you have behind you, what would you tell them most important thing to keep in mind as they were sort of getting started in the industry as an analyst?
Great question. I would say pay less attention to what you read in the newspapers, right? And even to this day, I have to remind myself of that, right? Because you could get the story right, but you probably get the market wrong, right? Right at the same time, right? If you thought, take tariffs, if you thought tariffs, they were going to, destroy the economy, and you would get the market wrong. If you were an expert on COVID and you got the COVID scare right, you got the market wrong, right?
Ooh.
So pay less attention to the news, read with the understanding of what it's trying to accomplish, and pay more attention to this price action in a vacuum, right? I think, we all want to be smart, read up on the news, and, we could talk to clients about, at the end of the day, there's a big separation between markets and news, markets and the economy, markets and GDP. So if you want to be a student of the market, study the market, and everything else is secondary.
JC, in my Fidelity chart room days, one of the quotes we had hanging up in the chart room for everyone to see: "Forget the news and remember the chart." And I love that that comment that you made. I would wholeheartedly agree. JC, listen, it was great to see you in Boston. Thanks so much for coming on the show. Great insights, great investment wisdom, and with some good humility sprinkled in as well. So thanks for coming on the show today. Good to see you.
Thanks, Dave. You too. This is great.
I love that quote. As the market evolves, your toolkit has to evolve with it. So many times, and honestly, I've seen where people find a really good set of indicators or an approach that just happens to work really well for a very particular set of market conditions. And what I've learned over my career is there are periods of high inflation and low inflation. There's high interest rates, low interest rates, where gold is going up or going down, when stocks are in primary bull markets, primary bear markets, when it is a broad advance or a narrow advance, and all of those different conditions, to say nothing of the fact that market structure has dramatically changed with all, just the way that the markets function now versus 26 years ago when I was first getting started in the industry. You have to evolve. And I find that, some investors just do really well for a very specific window, and then they're done, and they just are unable to adapt. They're so tied to that idea that they've cracked the code, and they don't realize that they just happen to have cracked the code for this particular set of conditions. And the successful investors I've worked with are able to recognize when the tides shift. They recognize when the previous playbook isn't the next playbook, and identifying those shifts. And so for us, that's why we always look for what I call changes of character in the market, right? Signs that conditions are changing, signs that the dynamics that are very clear and evident at one point are no longer clear and evident. I think the only way you identify those shifts is with a consistent process of analysis. And JC O'Hara, I would say better than anyone, has a pretty good consistent process. Love that conversation about the SpaceX IPO. That's obviously going to be a pretty key market theme for us to unpack here in June of 2026. But I think, his point about how it reflects the enthusiasm for the markets. And he's absolutely right. I mean, I think the challenge with this market is once the market, once these growth stocks keep going higher, like what's the incentive for investors to remain optimistic about future growth? And something like the SpaceX IPO and this idea that space is this new frontier for, future economic growth. I mean, certainly it's captivating investors right about now with the early read on what this IPO could do for the markets. Great comments about a technical approach. I love his thoughts about using technical analysis related to other disciplines. What's great about someone like JC is he spends most of his time talking to institutional money managers. And so as a result, in my, times of my career where that's been my focus, you learn how to have a deep technical discipline, but then how to use that information to have a meaningful conversation with someone who does not stare at charts all day. And that transition is not as easy for some as you might think. Some people are really good strategists and then they struggle to connect the dots for people and help them understand how to gain the benefits of a deep technical analysis process without, really deeply understanding all of those bells and whistles or, the squiggles and wiggles that we look at when we're evaluating charts. But I think JC really demonstrated how to think about technical analysis relative to valuations, relative to earnings, and just how we can relate those different approaches. By the way, we talked a little bit about stops, and I hope you picked up on what JC suggested, which I would wholeheartedly agree is kind of an important way to think about trailing stops. A lot of times we go with simplicity, right? An 8% stop or something like that, just as a simple way of minimizing our losses. And to be honest, if you have nothing else going on, if you have no other risk management strategy, a simple percent stop is a really good starting point. But I would encourage you to think of it as a starting point. There are other more, dynamic, more adaptive ways of using trailing stops. And I think using something like average to range, which is what JC hinted at, is certainly an area to think about if you've not done that before. Because average to range, what that does is it adjusts your stops based on the volatility of the stock or ETF that you're looking at. I think that's pretty vital. Great take there, and some great words of wisdom from JC O'Hara. Also some great takes on the current market environment. So thanks, JC, for coming on the show today. By the way, if you want to learn more about how to develop and upgrade your own process of evaluating technical analysis and market conditions and looking for changes of character, our premium memberships may be a great opportunity for you to navigate 2026 with success. 3 great benefits to the premium membership. First off, we'll teach you all about the markets and all about investing using technical analysis and behavioral finance through our virtual courses. Second, you'll have access to our members-only reports, like our weekly flight plan and our monthly chart review and frequent market updates during the week. Finally, you'll have full and immediate access to our member community where you can learn from other investors, you can ask questions, and learn from me all the week through as I answer questions of your fellow premium members. All of that can be unlocked immediately if you go to marketmisbehavior.com/premium, and I hope you'll consider becoming a premium member today. That'll do it for today's episode of the Market Misbehavior Podcast. My name is Dave Keller. Thank you so much for joining me, and remember, it's always a good time to own good charts. Take care, folks.